Good day. Welcome back to the taxation of individuals. Thus far, we have looked at Natural Persons Chapter 7, Capital Gains Tax Chapter 17. Today's discussion will center around Donations Tax Chapter 26. At the end of this chapter, you should be able to identify the basis on which donations tax is calculated, know who is responsible for the payment of donations tax, understand and know the rates applicable to the calculation of donations tax, know which donations are exempt from donations tax, identify transactions deemed to be a donation for donation tax purposes. Donations tax is payable on the value of any property disposed of by a South African resident in terms of a donation, whether directly or indirectly. The tax is levied at a rate of 20% on the value of the property donated if the aggregate value of the property donated does not exceed 30 million. If the aggregate value of the donation exceeds 30 million, the first 30 million of the aggregate value is taxed at 20%, while the excess is taxed at 25%. Even though the aggregate value must be determined to establish the applicable rate, donations tax is payable on each donation separately. Donations made on or after the 1st of October 2001 could have a possible reduction in the rate to compensate for possibility of CGT. The donations tax is payable the month following the month in which all legal requirements were fulfilled. Natural persons have an exemption of 100,000. Other entities have an exemption of 10,000 Rand per annum. Effectively, donations tax is a tax on the net transfer of assets. On whom is donations tax levied? We mentioned that donations tax is payable on the value of any property disposed of by a South African resident in terms of a donation. Non-residents are not liable for donations tax. When we make mention of a South African resident, it can be an individual or a company. It can also be any other South African resident entity. So what are the characteristics of a donation? What is a donation? The term donation is defined as any gratuitous disposal of property, including any gratuitous waiver or renunciation of a right. For disposal to be gratuitous, it needs to be for no consideration or free. We have deemed donations. This is where disposal of property for inadequate consideration, that is at less than market value, occurs. The commissioner will deem this to be a donation. Example, Mr. Benny sells property with a market value of 800,000 to his son for 500,000. What is the tax implications, if any? So the market value here is 800. It gets sold for 500. So it's a disposal of property for inadequate consideration, less than market value. The commissioner will deem this to be a donation. So how do we calculate donations tax? We say the 800 less the 500 equals to 300. But remember, Mr. Benny is an individual, so he gets the first 100,000 exempt. So 300 less the 100,000 gives you 200,000. Then 200,000 fits into a value which is less than 30 million. So we're going to multiply it by 20%, which gives us 40,000 Rand donations tax. Now if Mr. Benny makes a second donation, he no longer qualifies for his first 100,000, so that will be automatically multiplied by 20% to get your tax on it if the amount is still under 30 million. We will quickly touch on donations made by a company. If the position after 1st of April 2012, Section 57.1 and 57.2 was replaced with Section 57. And Section 57 is seen as an anti-avoidance section, where the disposal by a company under a donation at the instance of any person is treated as if the person in his own name made the donation if any property is disposed of by any company at the instance of any person, and B, that disposal would have been treated as a donation had the disposal been made by that person. the property must be deemed to be disposed of under a donation by that person. So basically what they're saying is, I own a company. I've utilized my 100,000 already. So now I insist that the company must make a donation to my child. The donation will then be seen as me making the donation, and I will have to pay the donations tax. Now we've looked at the first 100,000 being exempt for a natural person, and non-natural person will have first 10,000 rand per tax year exempt. Other main exemptions are also donations between spouses, bona fide maintenance payments, but please remember these need to be reasonable maintenance payments. Donations to approved scientific, cultural, educational or religious institutions, and donations cancelled within 6 months. Now when we're looking at the first 100,000 per year of assessment for natural person, a husband and wife are both entitled to this exemption. So now we know what is a donation and what triggers a donation. But we need to see how to value the property to include it into our tax return. The value of property is calculated per donation and not per year of assessment. So Mr. Benny donated to his son, triggers donations tax. Then again he donates to his daughter, triggers donations tax. He donates to his spouse, it will be exempt. So each donation will have a donations tax implication. Property other than limited interest, we're going to use the fair market value at the date of donation. If it's immovable property used for bona fide farming, we use the fair market value less 30%. Please note, bona fide farming is a strict definition per tax. We cannot have property which is farming property which we then rent out and say it's bona fide farming. We are not farming, we are renting. Okay, so how many of you remember Old MacDonald? Old MacDonald had a farm, right? So there's Old MacDonald, there's his farm. Now Old MacDonald has a son, young MacDonald, and we've got our little money pot here. So the farm is bringing in a lot of money. Now young MacDonald finds a girlfriend who he's planning on marrying. And Mrs. MacDonald and the girlfriend don't get along. So Old MacDonald is in a bit of a situation. He needs to set up his will, but if he leaves the farm to his son and his future daughter-in-law, they might kick the mother out on the street. And if he leaves it to his wife, she's not at the age where she can actually farm on this farm. So what does Old MacDonald do? In his will, he says he leaves the farm property to his wife and he leaves the farming to his son. So it's a win-win situation. The wife has land which she can then stay on and no one can kick her out, and the son has the right to do the farming on this land. So he still gets his money at the end of the day. So a fiduciary interest is created when a person donates or leaves a property to another person known as a fiduciary on the condition that the ownership will pass to a third person known as a fiduciary on the death of the fiduciary. So you're going to have a usufruct interest where full ownership of the property consists of two rights, namely the right of ownership and the right of use. If these rights were split between two people, one would have the usufruct, which in this case young Mr. MacDonald has the usufruct, that is the use of the asset, and the other has the bare dominium being the ownership, so that is Mrs. MacDonald. Okay. So we said there's a fiduciary interest, which is a limited interest. It's only entitled you to the fruits of the property and not to dispose of the property. So full ownership, we said, consists of two parts. The usufruct, the holder has a right to use the property but does not have the right to dispose of it, which is young MacDonald. The bare dominium, the holder can only sell the property subject to the usufruct. This is Mrs. MacDonald. The following calculation is for your benefit only. It is excluded from the scope of the syllabus for a tax technician qualification, but I am making mention of it so that you are aware if you ever see a fiduciary usufructuary or other interest in practice, you know that there's a calculation associated to it. So what we usually do is we take the fair market value on the date of the net donation, then we multiply it by 12% to get an annual value, right? You determine the lesser of 3 periods, the beneficiary's life expectancy, a shorter fixed period if, for instance, they say the use of right is for 5 years, or the donor's life expectancy. And then you have tables which you capitalize the amount at 12% per annum. So you've got your annual factor, annual value which you've calculated, times it by this factor. So that will give you your value then that you use to calculate your donations tax. Valuation of a bare dominium, similar to the previous one, also out of your scope of your syllabus. You can read through Silk if you want more information. Okay. Lastly, the donor and the donee will be jointly and severally liable in the case of non-payment of donations tax. There is an option of a 200% additional tax penalty if donations tax is not paid. Okay, and that brings us to the end of donations tax. If you have any queries, please feel free to email me. Thank you and goodbye.